Hey everybody, this is Mike with Practical Income Investing. Today's video, we're talking about Palantir. And, you know, I don't sit here trying to guess where the price of Palantir is going to be. I don't cancel purchases in Palantir because it had a green day. I don't sit here Uh, I don't increase my position because somebody on TV was like, "Oh, this is going to go today," or whatever. This is an automatic purchase because I believe Palantir is going to be one of the most important companies, software companies in the world by far. That doesn't mean that it can't go up and down a little bit. There's going to be some volatility, of course. It doesn't mean that long-term valuations uh, don't matter, and it certainly doesn't mean everybody should copy what I'm doing. But when I look at Palantir, I see four things coming. Uh, these things are going to be coming together basically at the same time. So the AIP adoption appears to be accelerating. Okay, government and commercial growth are both extremely strong. The company's rule of 40, it's at 145, which if you look it up, I'm going to explain it in my video here, but 145 rule of 40 is ridiculous. Okay, this is like off the chart kind of stuff. Um, and if you, and I honestly believe that Palantir is still has a long runway. I think this is going to be potentially still generational. I know it's ran up a lot, but honestly, this is a time I'm looking at it a lot. This is a potential great place for people to start their position. Um, I own uh, longer dated call options, uh, and I also own the stock as well. So this is going to be a great video for you to learn a lot of different things. So stay tuned. Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. Palantir is sometimes described as an artificial intelligence company, and that's true, but it's really incomplete, right? Palantir is not simply selling another chatbot. It's building software that helps governments and businesses connect their data. They understand their operations, make decisions, and then take action. So Palantir has four major pieces that work together. The first one is the Gotham, and Gotham is heavily associated with government, defense, intelligence, and other mission critical operations. It helps organizations combine large amounts of information, and that's used for like support in real world decisions. Okay. The Foundry is a commercial data and operations platform. So it could connect with information across like uh, a business such as like their inventory, factories, employees, customers and orders, supply chains, and in the physical, the financial system, all of it. Then they have Apollo, which that helps Palantir deploy and update its software across a whole bunch of different environments. So that's going to matter because Palantir may need to operate in the cloud or on a company's own servers, at the edge, or in a highly secured government environment. And then we have the AIP. This is the artificial intelligence platform. The AIP that connects artificial intelligence with the customer's real data. It also it connects like workflows and rules, all of the operations. So the important distinction is that Palantir is not trying to help somebody ask, you know, an AI question. It's trying to help organizations use AI instead of actual operations of the business, inside rather of the actual operations of the business. Palantir describes the combination of AIP, Foundry, and Apollo as an enterprise operating system. So this is much a larger ambition than simply saying selling across like a language model, right? So, uh, but the part of Palantir that may be the hardest for competitors to reproduce is not just their AIP by itself, but it's what sits underneath it. So one of the more important concepts in understanding Palantir is something called the ontology. That sounds complicated, but the basic idea is understandable. uh, a company has raw data sitting in many different places, right? So it might have like customer information in one system, inventory in another system, factory equipment, employee schedules somewhere else, financial information in another database. The raw data itself doesn't necessarily understand, how the business operates. Palantir's anthology attempts to basically map that information into real organization. Okay. A factory is not merely a row inside of a database. um, it contains machines, employees, production schedules, inventories, maintenance, customer orders, business rules, etc. So anthology connects those objects, relationships, rules, actions, all into one operational model. Palantir describes it as an operational layer, or in some situations, a digital twin of that organization. So an AIP can sit on top of all of that operational model. So that means that artificial intelligence is not merely guessing, based on disconnected documents. It can work with governed access to real data, real business objects, real rules, and approved actions. So, for example, like a system might identify a supply shortage. It might explain which customer orders can be affected, or it can recommend a new production schedule. Um, and with the right permissions, it could help an employee execute and approved action. So that's where the moat may begin to form, right? The deeper Palantir becomes embedded inside customers' actual operations, the more difficult and disruptive it becomes to replace, right? So the harder it is to uh, replace builds that moat. So this is not just like storing data, right? It's about connecting data, logic, actions, and security into one operation model. So a great technology story is interesting, but as investors, we still need to see proof that the customers are actually paying for it. And Palantir's latest numbers are no longer subtle. So, all right, so Palantir's first quarter 2026 results were just absolutely extraordinary. The total revenue reached approximately 1.63 billion, and that was a growth of 85% year over year. U.S. commercial revenue grew 133%, and the government revenue grew 84%. So total customer count reached 1,007. That's an increase of 31 from a previous year. Commercial customer count reached 832. So the net dollar retention was 150%. What does that mean? Customers included in Palantir's retention calculation were spending approximately 50% more than they did in the previous comparable year. So the current customers are spending more. That's important because it shows expansion inside the existing customer base. Customers are not merely trying a product and leaving, at least in aggregate numbers. They're expanding in their spending. So Palantir has also closed 206 deals worth $1 million during that quarter. 72 of those were worth at least 5 million. 47 of those were worth at least 10 million. So this is the exact software flywheel that we should begin to look at, right? So it starts with one problem, prove the value, expand into more departments, add more cases, use cases, increase the contract value, and eventually become deeply embedded inside the organization. The business is not simply just growing. The growth rate itself has accelerated significantly during these recent quarters. But revenue growth is only half the story, right? Palantir is producing a combination of growth and profitability that is really extremely rare. That brings us to the rule of 40. All right, so the rule of 40 is a common way investors evaluate software companies. The concept's real simple, right? We add the company's revenue growth rate to a profitability margin. So the combined score of 40 is generally considered strong. For example, a company growing revenue at 30% with a 10% margin would have a score of 40. A more mature company growing 10% with 30% margins would also have a score of 40. So it helps investors understand the balance between growth and profitability. So a company, really can spend aggressively to create high growth, or it can cut investments to create high margin. Doing both at the same time is much harder. Now, Palantir calculates its rule of 40 using year over year revenue growth plus adjusted operating margin. For Q1 2026, revenue growth was 85%. Adjusted operating margin was 60%. You add those two together, Palantir's rule of 40 score is 145. It's not simply above 40, it's operating in a completely different neighborhood, right? And this is one of those, you know, this this was not like a random jump from a low starting point. Palantir's rule of 40 progression moved from, like, I think it was 64 in Q2 of 2024 to 83 in 2025. That was Q1. 127 in Q4 of 2025. And now in Q1 of 2026, we're at 145. Now, let me be precise, right? Because the 6% figure is an adjusted operating margin. So that includes like stock based compensations and related payroll taxes. So we shouldn't treat this like exact same as GAAP operating margin. But even on GAAP basis, Palantir's operating margin was like 46%. So this means that the company's using accounting adjustments to hide unprofitable underlying business. It's not, that's not what they're doing, right? It is growing extremely quickly while producing real operating profit. Okay, so that brings us to the next question: is the profitability translating into actual cash? And of course, the answer is yes. So Palantir's financial strength is one of the main reasons I don't value this company like an ordinary growth software story. A company that generated 46 GAAP operating margin during the first quarter. Adjusted free cash flow was approximately 925 million, and that represents an adjusted free cash flow margin of 57%. Palantir finished the quarter with 8 billion in cash, cash equivalents, and treasuries. So it reported no debt. The balance sheet gives Palantir flexibility. Um, it can continue investing in product development. It can expand its sales efforts. It could pursue, government commercial opportunities, and it doesn't have to like have the same financing pressure that highly leveraged companies would face, right? So, we should address this stock-based compensation. All right. Palantir recorded approximately 202 million of stock-based compensation during Q1. That's roughly 12% of the quarterly revenue. Stock-based compensation is a real expense, and investors shouldn't pretend otherwise. However, Palantir produced approximately 754 million of GAAP operating income and 876 million in net income during that quarter. So diluted weighted average shares increased by less than 1% compared to the prior year's quarter. The stock-based compensation remains, something to monitor, but the current profitability and cash generation are very real. Now, we can finally address the argument people make all the time. Palantir is, every time it's discussed, right? The PE ratio is high, so the stock must be overvalued. This is not how I evaluate a company like this. Now, there's really no single number that tells us exactly what a company's worth. Every valuation method makes assumptions about the future. So for a company like Palantir, I'll use four major lenses, okay? So lens number 1 is growth. So how fast is revenue growing? Is the growth accelerating or slowing? Is the customer base expanding? How large uh, could the future opportunities become, right? Palantir's current growth is exceptional, but the key question is not whether it can grow 85% forever. I got some news for you. It can't. But the question is whether it can maintain a strong or very strong growth for many, many years as AI becomes embedded inside more government and commercial operations, right? So, lens number 2, profitability and cash flow. Is the company converting revenue into actual profit? Are margins improving? Is free cash flow real? Um, Palantir, Palantir is going to pass this test at a very high level. Um, my third lens, and honestly, probably my most serious one, if you follow me and know my 7 fundamental principles, moat and stickiness. So, how difficult is the product to replace? So, is it becoming more deeply embedded inside the customer? Does, each new development create more value, or is it just, does it have, okay, is it really producing a larger switching cost? Like, would it cost a lot to move to a different company, right? The ontology and Palantir's integration into mission critical workflows may create super big time substantial stickiness, right? So my lens number 4, valuation in context. So what assumptions are really embedded into the price? How many years of exceptional performance are investors expecting? Okay. And what return might remain for new buyers? So the PE ratio can be useful, price to sales can be useful, free cash flow yield can be useful, but none of those numbers should be viewed alone, right? A high multiple doesn't automatically mean the stock is overvalued. It means the market expects a great deal of future growth. Our job is to determine whether those expectations are reasonable, too low, or too high. I remember a while ago, early on when Amazon was around $6 or $7, its PE ratio was over 600. Well, look at Amazon now. If you invested in Amazon back then when the PE ratio was 600, you were considered an idiot, and now you're laughing. So, what exactly is the current market expecting from Palantir? This is where I agree with part of the bear argument, but not necessarily its conclusion. So, at the July 21st market price, Palantir traded near $133 per share with a market cap of 342 billion. So using that midpoint of Palantir's current 2026 revenue guidance, that works out to approximately 40 times forward sales, okay? So using the midpoint of its adjusted free cash flow guidance, it traded at approximately 79 times forward adjusted free cash flow. That represents an adjusted free cash flow yield of only about 1.3%, okay? Those are undeniably high traditional value multiples. I'm not going to pretend otherwise. The market's already pricing in substantial future success. But here's where I disagree with the conclusion that the stock must therefore be overvalued, right? Palantir is not growing at 15% with mediocre margins. It just reported 85% revenue growth. Its official Rule of 40 score was 145. Its GAAP operating margin was 46, and it has 8 billion in cash and treasury securities with no debt. Its existing customers are expanding their spending rapidly. And Palantir believes full year 2026 revenue is going to reach approximately 7.65 billion to 7.66 billion, which would represent another growth of about 71%. The company also expects commercial revenue to grow at least 120% for the year. So valuation argument is Palantir cheap using normal ratios? It's not. The real argument is how long can this unusual combination of growth, margin, expansion, and competitive advantage continue? Under a short duration model, the stock's going to look extremely expensive. I get that. But under a long duration model, where Palantir becomes foundational operating system for governments and major businesses, the current price is still going to be reasonable, honestly. That's why I lean towards Palantir being fairly valued or potentially undervalued despite the high headline multiples. But, this thesis requires continued execution, and that brings us to the balanced view. The opportunity is real, the expectation is also real. And wow, is it thunderstorming where I live right now? I don't know if you can hear it, but I'll leave it in the video. You can see the emotional and uh, uh, the peril that I'm in currently trying to make this video for everybody. I hope you guys appreciate this. So the bull case begins with strengths of the product. AIP adoption appears to be accelerating. Commercial growth is expanding rapidly. The government business remains very strong. Margins and cash generation are exceptional. The balance sheet is basically perfect. And Palantir software is becoming increasingly difficult to replace as it becomes more embedded inside of operation and workflow. So the company has exposure to both government and commercial AI adoption. That gives Palantir more than one path to a long term growth. Now, for the risks, okay? The risks are expectations. Even with the valuations, they can be adjusted. The stock price for exceptional performance can react violently to mere good performance, right? Palantir does not need to fail for the price to decline. It could the growth could simply slow faster than investors expected. The second risk is execution, right? Palantir can continue converting interest in AIP into large, durable consumer relationships. But the third risk is the competition. Large software companies, cloud providers, data platforms, defense contractors, and specialized AI companies are all going to compete for this part of this opportunity. The fourth risk is the government and political exposure. Government's budgets, contract awards, procurement timing, regulation. The policy or the political controversy can affect businesses, and it can affect the stock. So we also need to be watching the consumer and receivable concentration. So Palantir reported that no single customer represented more than 10% of quarterly revenue. However, one customer represented 31% of accounts receivables at the end of Q1. Account receivable concentration is not really the same thing as the revenue concentration, but it's still worth looking at. And finally, we must continue watching stock-based compensation and dilution. A great company can still produce poor investment returns, or too much future success is already reflected into the price. So my belief is that Palantir's opportunity is larger than the risks, but the risks still deserve respect. So with all that information, here's exactly how I'm personally approaching Palantir. So my Palantir plan is based on owning a great company for a long period of time, right? So first, I maintain a weekly automatic purchase. So that removes my emotions from decisions. It's just an automatic every single week. I'm not trying to predict whether Palantir is going to be up or down next Tuesday or whatever. I'm building the position gradually. Secondly, I'm treating Palantir as a long-term core holding, so I'm not buying the shares because I think the next 5 trading days are going to be green. I'm buying because I believe the company can significantly be larger over many years. I'm using my dollar cost averaging system to get into larger positions with the company. So when you have these volatile moments, when you have these pullbacks, I increase my buying on those pullbacks. The further the pullback, the more I'm increasing my buying. And I'm also buying leaps. I own several leaps. For additional long-term duration exposure. So options involve more risk than shares, so that exposure is going to be sized appropriately. Um, and like I said, during pullbacks, I don't get emotional. I don't chase large upward moves. I just constantly uh, invest in this company. So revenue growth, commercial growth, operations margin, cash flow, net dollar retention, customer expansion, AIP adoption, stock based compensation, the rule of 40. My thesis is not that Palantir can never become overvalued. My thesis is that traditional multiples just simply don't apply to a company that is growing this quickly with the level of profitability while potentially building a foundational operational system for the age of artificial intelligence. I believe Palantir is still early in their cycle. This is why I continue buying each and every week. Here's the Palantir company snapshot with major Q1 2026 operating results. The business is executing at an extremely high level. Feel free to pause the video and take a screenshot of this for your own education. So, and here's the valuation snapshot. The traditional multiples are high, but Palantir's growth, profitability, cash flow, balance sheet, and the rule of 40 provide a context behind my long term valuation thesis. So, here's a second snapshot you can use. So, Palantir is helping governments and businesses, artificial intelligence, inside real world operations. But underneath all of that software, the AI infrastructure still needs to move enormous amounts of data between chips, servers, racks, data centers. So this is going to create another major technology and investment opportunity. So in my previous video, I explained why AI data centers are increasingly moving from copper to light, and where companies such as Corning, Arista, Broadcom, Coherent, Lumentum, and Poet fit inside that infrastructure stack. I'll put this video up on the screen right now, and then subscribe to Practical Income Investing, because after Palantir reports its second quarter results on August 3rd, we'll come back and see whether the new numbers will support my thesis. Okay. So remember, high quality company is not automatically good investment at every possible price, but a high PE does not automatically make an elite growth company overvalued either. Right. Look at the whole business, understand the risks, and invest with discipline. Thanks for watching.